Welcome back to Iron Financial, the only place where we help you forge a stronger portfolio by cutting right through the market noise. And today, we're putting Deere Company on the anvil. They just dropped their Q1 numbers, and man, the market went wild. Market Skeptic. Wild is putting it mildly. But you know me, when a stock pops like that, but the profits are actually cratering, that sets off all my alarm bells. So today, we're going to stress test this thing. We're going to see if this is a truly solid foundation or if it's just a trap waiting to spring. Let's get into it. Okay, so let's start with the big one. This number right here is why we're talking about Deere today. We're talking about a 12.72% surge in a single day. I mean, come on. The market saw the headline beat on earnings, it glanced at the revenue, and just boom. It voted with its wallet, plain and simple. You see a nearly 13% jump, you think, what's not to love? This right here is the bull case in its absolute purest form. It's a massive, immediate, positive verdict from the street. And you know, on the surface, this thing looks like a screaming buy. Whoa, hold on a second. Let's not get hypnotized by the green ticker tape just yet. When I saw that stock taking off like a rocket, I did what we always do here at Iron Financial. I went digging. I blew right past the headlines and got into the guts of the press release. And this is the number that just stopped me in my tracks. Net income. You know, actual real profit. It was down 25% from last year. So let me get this straight. The stock shoots for the moon, but the actual cash machine, the profit engine of the company, just fell off a cliff? That makes absolutely no sense. It's a huge contradiction. And it means one of these numbers is telling the real story about the company's health, and the other one? Well, it might just be a whole lot of hype. And that right there is the entire game. That's the central question we have to answer today. Is all this market euphoria actually justified? Are we looking at a company that's tough, that's navigated the storm, and is now building a brand new solid foundation for growth? Market skeptic? Or is this a classic bull trap? Is it just waiting to snapshot on anyone who gets too greedy? Is that big, shiny revenue number just a distraction to cover up some really deep structural problems under the hood? Well, that's exactly what we're here to find out. So here's how we're going to do it. This is our blueprint for today. We'll start with that conflict, that tale of two numbers. Then we're going to deconstruct the entire Deere machine. We'll find the pillars doing the heavy lifting, but we're also going to hunt for any cracks in the foundation. We'll size up the headwinds, and then, at the end, you'll get the Iron Financial verdict. Let's go. All right, first things first. To really get what's going on with a behemoth like Deere, you can't just look at the big, flashy numbers on the surface. No way. You have to pop the hood and take the whole thing apart, piece by piece, just like a complex engine. We need to see which cylinders are firing and, more importantly, which ones might be leaking oil all over the place. The real story, the one that matters to your portfolio, is always hidden deep inside the data. And this chart really lays out all the moving parts for you. It's pretty clear, right? You've got three main engines driving this company. Now, I know the headlines were all screaming about the growth in construction and forestry, and trust me, we'll get to that. But just look at the size of these pieces. That big green chunk, production and precision ag, that's the big stuff. The massive combines, the high-tech tractors. It is still the largest single part of the business. It's the absolute heart of the machine. And that means its performance, whether it's good or bad, is going to have a huge outsized impact on everything else. Don't forget that. Okay, so let's give the bulls their due. Let's start with the good news. The reason that stock popped almost 13% is because two of Deere's three big engines were running red hot this quarter. I mean, absolutely on fire. These are the pillars that are holding up the entire growth story right now. So let's put on our hard hats and go examine their structural integrity. Let's see if these things are actually built to last. First up, let's talk about small ag and turf. Check this out. Sales rocketed up 24% year over year. That is a monster number, plain and simple. We're talking about everything from the smaller tractors you see on family farms to the riding mowers cutting grass across suburbia. It looks like they finally ramped up production, and boy, was the demand there waiting. This is just a clean, simple, undeniably good story. But here's the best part. Look at how that sales growth turned directly into some heavy-duty profit. Now, for those of you watching, this is what we call a waterfall chart. It just shows you how you get from point A to point B. See that number on the far left? That was last year's profit, $124 million. Now, follow me across. That huge green bar right in the middle, that's a $148 million boost just from selling more stuff, what we call volume and mix. It's that simple. They shipped more machines, and that cash flowed right to the bottom line, pushing their total profit up a massive 58% to $196 million. This is what a solid pillar of growth looks like. All right, now let's move on to that second pillar, construction and forestry. And wow, a 34% sales explosion. That number is even bigger than what we saw in small ag. This is all the heavy iron, right? The excavators, the dozers, the stuff that's building our roads and buildings. And you better believe the market saw that 34% and went absolutely nuts. But hang on, a huge sales number doesn't automatically mean it's quality growth. The real question is, are they making any money on it? And this, folks, is where my alarm bells start ringing again. Yeah, sure, operating profit more than doubled. Sounds great on paper. And just like we saw before, you've got this massive green bar for volume and mix, a $162 million boost. But now, look at the final numbers. I mean, really look. They brought in over $2.6 billion in sales and only turned that into $137 million in profit. You know what that is? That's an operating margin of just 5.1%. That is razor thin, people. So yeah, this segment is doing a lot of heavy lifting on the sales side of things, but it's not adding much to the structural integrity of the company's profits. It's a big, flashy pillar, but I'm worried it might be hollow on the inside. Okay, so let's recap where we are. We've got one really solid pillar, and the second one that's big and flashy, but maybe a little weak under the surface. So now we have to look at the foundation itself. We're talking about production and precision agriculture. This isn't just another segment. This is Deere's flagship. It's their core identity. And this quarter, folks, a massive crack just appeared right down the middle of it. A 59% collapse. Just let that number sink in. This isn't some minor dip. It's not a soft patch. This is a catastrophic failure of profitability in their single most important business. So while everyone else was popping champagne over the growth in the smaller divisions, the main engine of the entire company just completely seized up. What's crazy is that sales were actually up a tiny bit, but the profit? It just, poof, vanished. This is the big, ugly, unavoidable number that completely demolishes the bull story. All right, let's use another one of these waterfall charts to really break down this disaster, because you need to see this. It's critical. See the bar on the far left? That's where they started last year, a really healthy $338 million in profit. Now look at all that red. Every one of those red bars is a cost that just chewed away at that profit. You've got a $61 million hit because they sold a less profitable mix of equipment, then bam, another $48 million hit from higher warranty costs. And then look at this last one, a crushing $74 million hit from production costs, and that includes those nasty tariffs. These aren't rounding errors. These are massive, massive headwinds that just completely hollowed out their profit, leaving them with a measly $139 million. And this bar chart right here, this just puts it all into perspective. It's the whole story in one picture. This is the crucial point, so pay attention. Look at that bar on the far left for production and precision ag. This is supposed to be their biggest, their best, their most profitable business, and right now it is their least profitable. A margin of just 4.4%. It's an upside-down pyramid. Their smallest business is literally carrying the profit load for the entire company. This is not stable, it is not sustainable, and it is a giant red flag that the market and all its excitement seems to have just completely ignored. So the internal machinery is pretty clear, right? We've got two segments growing like crazy, but with some questionable profitability, and the core business is just crumbling. So now let's zoom out. What are the big external forces hammering this company? And what is management actually telling us about how they're going to navigate this storm? Because look, a company's real strength isn't just one good quarter, it's how they handle adversity. And this slide really shows you the tug of war they're in. The tailwinds, the things pushing them forward, they're powerful. I mean, look, they raised their full-year guidance for net income. That's a huge vote of confidence in themselves. They're banking on future infrastructure spending, and the CEO is out there sounding incredibly optimistic. The bull case is that this positive momentum is strong enough to just power right through the storm.
Yeah, but those headwinds aren't some fuzzy, far-off problem. We're talking about management themselves calling out a $1.2 billion hit from tariffs this year. That is a giant concrete anchor chained to their earnings. Plus, they're admitting that the entire market for their big ag equipment in North America is going to drop by 15 to 20%. So the bulls can talk about optimism all they want, but optimism doesn't pay a $1.2 billion tariff bill. That's real cash walking out the door.
And this brings us to the big quote from the CEO, John May, that every bull is clinging to right now. He's literally calling the bottom. He's saying, yep, things are bad, but this is it. This is as bad as it gets, and from here on out, we're growing. Now, as an analyst, you have to ask yourself a tough question. Is he saying that because he's got a crystal clear view of their order books and sees a real recovery coming? Or is this just the kind of corporate cheerleading you have to do when your most important division's profits just fell off a 60% cliff? And look, to be fair to him, he did put some real numbers behind that optimism. This table right here, this is the absolute core of the bull argument. Just look at that top line. They raised their net income guidance from a range of 4 to 4.75 billion all the way up to 4.5 to 5 billion. That is a massive boost in expectations. They're telling the market flat out that they expect small ag and construction to each grow sales by 15% for the whole year. And they're saying this while also admitting their biggest business is going to shrink. So the bet, the entire bull thesis, is that the strength in those two smaller segments is going to be more than enough to carry the weight of the rotting core business. It is a very bold bet on diversification. Okay, we have taken this machine apart, we have inspected the pillars of growth, and man, have we found the cracks in the foundation. We've sized up the headwinds, and we've listened to management's plan. So now it's time. Let's put all the pieces back together and deliver the iron financial verdict. Is this huge rally in the stock a real opportunity, or is it a very dangerous trap? And this table really lays out the final blueprint. The bull case, you have to admit, it's compelling. It's all about successful diversification. The massive growth in small ag and construction is supposed to prove that Deere isn't just a big tractor company anymore. They smashed expectations on the headlines, and management is so confident that they jacked up their guidance for the whole year. They're basically screaming, we've hit the bottom. But, and this is a big but, the bear case is built on the cold, hard reality of the numbers you can't ignore. You simply cannot ignore a 59% profit collapse in your biggest and most important business. You can't just wish away a $1.2 billion tariff bill or a 20% market decline. And you sure as heck can't build a strong, durable, long-term company on growth that's only delivering a 5% margin. The core business has a very serious, very real problem. And that's the final showdown right there. It's diversification versus a deteriorating core. So that brings us back to the final question. You know the deal here at Iron Financial. We don't tell you what to buy. Our job is to give you the blueprint, to give you the tools so you can forge a stronger decision for yourself. You've seen the good stuff, the impressive top-line growth that got the entire market so excited. But you've also seen the bad, those really dangerous cracks in the profit foundation of their most important business. The bull case is a bet. It's a bet that these new growth pillars are strong enough to hold up the entire company while they try to patch up that broken foundation. And the bear case is a warning. It says that a crack that deep in a foundation will eventually bring the whole building crashing down, no matter how shiny the new paint job is. We've given you the facts, so the question you have to ask yourself now is, are you betting on those shiny new pillars? Or are you worried about that crumbling foundation? The choice is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.